In this video, I'm going to be talking about 11 legal tax strategies that will help you keep more of your money, more of your hard-earned income, how to invest it, and how to build long-term wealth. So with that, let's actually jump right in. So in this video, I'm going to be talking about three key things. First, we're going to be talking about tax strategies that are used by the wealthy to save you more money so you can keep more money and build wealth. Second, we're going to be talking about simple ways, very easy to implement, how to implement them, and it's going to be step by step. And number three, we're going to be talking about strategies to help you build long-term wealth, to help your family, and ultimately build generational long-term wealth. So very quickly, why should you listen to me? Why Fiona? First, I've actually had firsthand experience working with 453 millionaires. I've been working with them for 7 years as a wealth advisor, helped manage $600 million, and by literally using the same strategies I talk to you today and in my past videos, I became a millionaire at 27. Again, I practice what I preach. I also went to Harvard, went to MIT, and I'm a CFP. I have over 11,000 hours of studying on top of course, the 7 years working with the millionaires in the industry. So with that, let's actually get started. So I think the best kept secret, and oftentimes a pretty big misconception, is what you keep is so much more important, right? It's greater than what you earn. Oftentimes, I have a lot of clients say like, hey, actually what I earn is so important. So if I make $1 million, I should be rich. And the answer is no. If you make $1 million, you're not really rich. What determines if you're wealthy, I should rather say, is how much money you keep from your income and how you invest it. As a very quick example before I jump in, I had a client, he was a lawyer at one point, and he was making about $950,000 per year. That's his income, right? And now oftentimes people would say, oh, that means he's rich. Well, guess what? He was not rich. He was in his early 60s and had about $100,000 saved. I think given the income that he was making and given his age, I wouldn't really characterize that as rich. So what is the moral of that story? It's all about how much money you keep. And that's exactly what we're going to be talking about in this video. So here is how you can keep more of your own money by legal tax strategies and how you can use that money to build wealth. So let's jump into the first point, which is employ your kids. Believe it or not, if you are a business owner, even if it's a side hustle, whatever it is, if you have kids and if you own your own business, I would suggest to think about employing your kids. And it works really well if you own your own business and if it's generating cash flow, of course, right? So think about it this way. If you have a business, right, you're the parent and you have kids, and let's say they're also responsible and they can do things like filing, I don't know, folders or maybe making calls to clients, reaching out, very basic things. But if they're able to do that, you can employ them and pay them a minimum salary, which we'll get to in a second. The point is you can pay your kids and then actually invest that money for your kids so it grows long term, right? Using compounding interest. So in 30, 40 years from now, especially if your kids are like 15 years old, well, 40 years from now, they'll be what? 55 years old. If 50 years from now, they'll be 65 years old. That money will very likely have grown to quite a few $100,000, if not $1 million. So how do you do it? If your kids are under 18 years old and you think they're responsible and you have the money, of course, consider employing them. You can pay them up to $15,000 per year for 2025, and that would be tax-free for your child. And we'll get into that in a second. You can then deduct your kid's salary from your taxable income. Again, as a business owner, you can certainly deduct at least a portion of those salaries so you can save some money in taxes. Now, when you employ your kid, right, that is a business expense, which relates back to this third point. Because your kid's salary is a business expense, that is then deductible. It's tax deductible. And so just like I put here, business expenses are tax deductible. This is according to the IRS, right? So children employed by parents, there are some certain rules. Make sure you're familiar with them, right? So it's they're not subject to income tax withholdings, also not subject to Social Security and Medicare taxes until they're age 21. So typically this works well if the kid is, under 18 years old or something like that. And also not subject to FUTA taxes as well. So there are quite a few benefits, especially for the business owner and of course for your kid. So make sure you read these rules a little bit further on with the IRS. I'm going to jump over that. But the point is, you might be asking, why $15,000? The point is, $15,000, there's a thing called the standard deduction, right? In 2024, that number was 14,600 every single year. The standard deduction, generally at least, increases due to something called inflation, right? We're all familiar with that term. So in 2025, that standard deduction now, if we're looking for the schedule, is $15,000 for those who are filing single. Or married filing separately, but I'm assuming if your child is under age 18, they're probably single. So why $15,000? It's because the income that they make, assuming you pay them $15,000 as their employer, would then be tax deductible under the standard deduction for your child. Not to mention that you as the business owner also get some tax benefits, again, due to the point that a salary in general is a business expense, which then comes down to tax deductions. All right, so that's one thing that you can certainly think about. And then if you do deduct your kid's salary, let's say you do pay them up to $15,000 a year, you can then actually invest that money on behalf of your kid into a custodial. This is what it's called, custodial. So you're actually the custodian, but the owner is still your kid. So it's for the benefit of your kid, but you are the custodian, right? Because you're over age 18. That's generally what it means. So you can invest it in a custodial Roth IRA, for example, or a traditional IRA, or a regular investment account, right? So just make sure a Roth IRA or a traditional IRA, the limits apply, right? So you can't put in $15,000 in an IRA because that's over the limits. Make sure you research the limits, which I believe are $7,000 for a year. All right. So with that, let's move on to step number 2, which is S Corps. S Corps are really cool. So with that, let's jump in. So S Corps, I drew this shield here because S Corps really do 2 things, right? They give you a salary as a business owner, and they also give you distributions. Now, there's a very key difference, and it all comes down to how these 2 are taxed. Salaries are generally taxed at less favorable rates, and distributions are typically taxed at more favorable tax rates. So let's get into that. And it all comes down to payroll tax savings, right? So S Corp, the way I want you to think about it is like a house, right? So the LLC is kind of the foundation. So if you have a business and you elect to name it as an LLC, that's the foundation, right? And then you can elect on top of the LLC to tax it as an S Corp. So an S Corp is generally more of a tax filing status, right? Yes, there are also elections, like you only can have, I believe there's 100 shares, so 100 shareholders, they have to be domestic in the United States. There's many other rules around that, but for right now, let's just focus on the S Corp status being a tax status. And the tax status has some savings, which we'll get into here. So first, there's self-employment taxes, right? You'll have to pay self-employment taxes, Social Security, Medicare, but you won't have to pay that for any distributions. We'll get into that too. And roughly, for every dollar of S Corps, for every dollar, S Corps save up to 15.3%, right? So that's how much you roughly save. And here's the reason why. First, with S Corps, you can take a reasonable salary. So just Google it on Glassdoor, see how much people in your business normally make. It can be $30,000. So that $30,000, you will have to pay Social Security and Medicare taxes on, right? You have to, because it's salary. But anything else you can take as a distribution. Now, think back to this nice shield that I drew. You have 2 components. You have the salary, which you have to take, again, a reasonable salary, but then you get something called a distribution. And the distribution is where you make the majority of your tax savings. Now, here's an example. The S Corp advantage here is that you only pay the FICA payroll taxes on your employment wages. So again, this means your salary. So anything on your salary, you do pay the taxes on. But any of the other profits in your company, assuming you are, cash flowing quite a bit, you can then use as distributions. And those distributions are not subject to these self-employment or FICA payroll taxes, right? So that is really the big benefit. Of course, your company has to be profitable in order for you to make these savings. And oftentimes, for it to be profitable, to actually build an S corp, you probably want to have income between like $50,000 to $90,000. Some accountants say that, $80,000 per year in gross earnings is kind of the sweet spot where you want to elect into an S corp. I'm not an accountant. If you are a business owner and you do have cash flow business and you're somewhere around this range, make sure you talk to your own accountant. They'll know your situation way better than I can. Moving on, number 3, HSAs, health savings accounts. If you want more in-depth information, make sure you check out my old HSA video where I talk a lot about these really cool accounts. Why do I have 3 locks? I have 3 locks because it is a triple tax benefit account. It gives you a tax deduction for any contribution. It gives you a tax deferral on any growth. And then for any withdrawals, note my little asterisk here, as long as they're for qualified medical expenses, you won't actually be taxed, right? So for anything you take out, no taxes owed, as long as they're qualified medical expenses. So that's why we have these 3 locks. Now, we already talked about the triple tax benefit as long as you have a high deductible health plan. Again, if you're wondering what these terms are, go back to my old HSA video. I go into a lot of depth there. Make sure you check out my recent HSA video there. Moving on, 1031 exchanges. This is a great strategy for you to save money, especially if you're into real estate transactions. That's where 1031 exchanges really come into play. So what does this mean? It means you can legally defer paying taxes on gains or profits, right, of highly appreciated real estate investments. It's essentially where you swap one real estate investment, like a property, for another, right? And so there's many rules. This is very simplified. There's many rules that go into this. Just like I said here, some of the rules here are it has to be like-kind property. So, it can't, I think it can't be like a parking lot or like a piece of land, like farmland switched onto an apartment residential building or like a commercial property. Make sure you double check the rules. But the point is it has to be like kind. It has to be for investment purposes. So it can't be like your personal property. There's another tax savings rule that we'll go over here in a few minutes. It has to be greater or equal value. This here is a type of tax terminology, boot, same tax place. So then there's a 45, you have to identify the property within 45 days. You have to actually purchase it with 180 days. There has to be an intermediary, right? So like a third party that's not involved. So very, very complicated. Check it out if you are thinking about it. But know that if you are the owner of an investment property that has a lot of profit and you don't want to pay the taxes on that profit, or you can't because you don't have the liquidity, just know that you can actually sell it within that time frame and following those other rules, and you can swap it for another real estate property. So you can defer you legally paying taxes, meaning you don't have to have like liquidity in order to pay it for currently. Again, make sure you find a CPA to find more information on that. Now, I did talk about primary residence's capital gain exclusion, and that's exactly what we're going to get into this. So a primary residence, for those of you who are unfamiliar, it essentially means your house, where you live, right? And there's certain rules that go along with that too, like what is defined a primary residence. Typically, it means you have to pass the homeownership test, so you have to have owned the home for at least 2 years over the last 5 years leading up to the sale. And also obviously lived in the house, right? Must have lived in the home as a primary residence for at least 2 years during the last 5 years. I believe the 2 years don't have to be consecutive. So you could have lived in 1 year, rented it out for 3 years, and then lived in it another year, right? So as long as you did live in it for 2 years though, and you can't have used it for another sale exclusion, right? And what this means is, let's say you bought your house. This here's an example. If you're a single person, let's say you sold your house at $750,000. Your basis, what you bought it for, is $250,000. So you subtract your gain, your profit, minus what you actually paid for it in the beginning. Your gain is then $500,000. And so if you're single, you get a $250,000 capital gain exclusion, meaning you don't have to pay taxes on up to $250,000 of gains. If you are married, you don't have to pay taxes on up to $500,000 of gains in your primary residence, right? So that's the difference here. And again, it only applies to your primary residence. And make sure, if you're ever worried, check out the rules for eligibility. All right, moving on. Point number 6, muni bond investing. Muni is short for municipal bonds or city town bonds. Oftentimes, if you're in a higher tax bracket, like 32% or higher, you should probably consider investing in muni bonds because they generate passive income, and they also don't always, not all the time, but don't always charge state and or federal income taxes on the income generated from these bonds. So there might be some taxes charged. It depends on your state. It depends on your tax bracket. Make sure you check with an accountant. But these are some interesting bonds. They can be good muni bonds. Depends on how risky your city or town is that you're investing in, but certainly it can have drawbacks, right? Because the passive income generated can impact your Social Security benefits. It can impact a couple of other benefits that are calculated based on your overall income. MAGI just stands for Modified Adjusted Gross Income. So it can certainly have an impact on other benefits that you might be receiving. Again, make sure you check with an accountant, but muni bonds are certainly a good investment there. Number 7, QCDs or qualified charitable distributions. This here is generally for someone who's 70 and a half or older. So if you're charitably inclined, if you're near RMD age, so RMD stands for Required Minimum Distribution, which is generally for IRAs, specifically traditional IRAs or traditional 401ks. Uncle Sam wants to get their taxes out, so there's a certain formula that's calculated based on the ending balance of your 401k or your IRA, and you're required to take that balance out. Doesn't mean you need to spend it all, but you're required to take it out and pay taxes on it. In 2025, the RMD age is 73, so you're forced to take out a certain amount of money and then pay taxes on whatever you have to take out. In 2033, that RMD age goes up to 75. Now, if you don't need the RMD, if you don't need the amount that you are required to take out of this IRA or 401k, you can actually gift it directly to a charity, especially if you're expecting to pay a lot in taxes, right? Especially if you're in a higher tax bracket, you don't want to deal with paying these taxes on the RMD. What you can do is literally take it out of your IRA, this RMD, and directly gift it to charity. You don't take receipt of this RMD. So the RMD, you can take out and you can gift it directly to charity. Now, there are certain limits how much you can actually gift as for a QCD. That's $108,000 in the current year. Believe it or not, there's some people that the RMD, the required minimum distribution, is far above $108,000. So you can only do $108,000 starting at age 70 and a half. So if you're age 70 and a half, you can start doing QCDs. Most people wait until they are forced or required to distribute from an IRA, but you can start at 70 and a half. You don't pay a penny in taxes, just don't take receipt of your RMD. Again, talk to your financial advisor or tax accountant for more information. Point number 8, defined benefit plans, DBPs. These are really good, but specifically if you're self-employed making a lot of money, we're talking millions of dollars probably, or hundreds of thousands, and you want to save a lot of money in taxes specifically for retirement. So a defined benefit plan, there's lots of legalese, there's lots of paperwork, so they are pretty expensive to keep and maintain, but if you're making millions or hundreds of thousands of dollars, they might be a good way to put away money. You can actually contribute up to $3.5 million in some plans, not in all, in some. How is that determined? It's based on actuarial calculations, so you have to hire an actuary, and that's based on your age, on your income, and on a couple of other factors. So like I said, it's very involved, which means it's also going to cost you a lot of money to set it up. But the benefit is you get tax deferred growth, tax deductible annual contributions. So if you put in $1 million, that $1 million is going to be deducted against your income, right? And then you also can roll over your benefits to an IRA at retirement. So there are many benefits, but again, make sure you talk to an accountant. And I mean, I'm hoping that you have an accountant, especially if you're making several hundreds of thousands or millions of dollars, right? At that income level, you should absolutely have an accountant to work for you. DAFs, these are really fun, donor advised funds. Anyone can open one. You can be You can be 20 years old, you can be 60 years old. And you can put in like $50 or $100,000 or more. Now, who can open it? Anyone, like I said, and you can invest in a donor advised fund in America online. So literally Fidelity, for example, has a donor advised fund portal. You put in your information, you apply, you open one. Anyone can do it. You receive an income tax deduction, right? Income tax deduction in the year, very important, in the year of the contribution. So in the year that you contribute to your DAF, when the money goes into the DAF, that's when you get the deduction, not in the year that you actually gift to charity. This is important because oftentimes people, when they put money into a DAF, they then invest their money, right? And so oftentimes they invest it for like 5 to 10 years. And during that time, and then after 5 to 10 years, then they gift it to charity. When you gift it to charity, you are no longer getting that deduction. Even if your money grew by like $100,000, you're not getting the income deduction. You're getting the income deduction in the year of the contribution. So when is this a good planning strategy? If you get a really big bonus check, let's say you get $1 million bonus or $500,000 bonus, you don't want to pay all of the taxes on that bonus because you also have your income, your regular income on top of that. Maybe you can take a chunk of that bonus and put it into a DAF, into a donor advised fund, get the deduction right away in the year of the contribution, but you don't have to gift it to charity in that year. That's generally a pretty good tax planning strategy. Again, involve your CPA and your wealth advisor in order to get more insight there. If you have non-cash assets, so real estate, for example, highly appreciated stocks, you can get up to a 30% of adjusted gross income deduction. Cash, if it's just cold hard cash, like that bonus check, for example, you can get up to a 60% deduction of your adjusted gross income. Here are all of the assets you can donate: farmland, grain, I didn't even know that, cash gifts, life insurance, mutual funds, etc. Real estate, this is a big one, especially if it's appreciated. You can put that into your donor advised fund, and then you can pick the amount and the timing of your grant. So there's a lot of freedom as a donor with donor advised fund, and it's a very simple type of charitable gift that you can set up. I think it's very simple. So look at this column here for donor advised funds. Again, it's just talking about how much you can actually get deducted compared to your adjusted gross income, right? So just make sure you check this out. Talk to an accountant for more information. Solo 401ks or solo Ks, these are really cool. Again, if you're a business owner and you do not have any employees, it's also available to your spouse if they earn income from the business. So I think this is a really cool strategy to build retirement wealth and also get a tax deduction. So contributions you can put up to the maximum 401k limit as both your employer and your employee. Like, you are the employee, and then you can also put money in as the employer, which equals $70,000 in 2025, which is a lot of money. So in 2025, right, so we're looking here, you can put as the employee, so this here is the employee, 23,500. As the employer, you can also put in 46,500. Plus, if you're over age 50, you can put in 7,500 on top of that as a catch-up, or according to a revised Secure Act 2.0, you can put in, right, you can put in if you're 60, 61, 62, or 63, you can actually put in 11,250 instead of 7,500. This is not, I don't know why this just went off. This is not on top of, right? It's not on top of, but it's instead of. So, yeah, so that's pretty neat, especially if you're older, you want to stash more cash, you're making a lot of money, and your spouse also has the ability to, put money away in a 401k. This is fantastic. And then finally, the last one, a TLH, also known as tax loss harvesting. So tax loss harvesting is a really neat tool that you can do at any age as long as you have some sort of investments in a taxable account. This will not work if you have an IRA or some other type of tax-deferred retirement account. So you can cut your tax bill with tax loss harvesting. How it works is if you sell an investment at a loss, if you have a loss, then this loss can actually decrease any taxable gains or even ordinary income. So regular income you earn from a job up to $3,000 a year. Just make sure you're aware of this thing called a wash sale rule. So you can't sell a stock at a loss and then buy it back right away within 30 days. And I have a picture to really show this, or anything similar. So if you buy like a mutual fund and then you sell it and then you buy a mutual fund that's exactly the same except one stock, maybe one stock different, that also won't work. So got to make sure you pay attention to this wash sale rule. And then if it does fall under the wash sale rule category, that taxable loss and the benefits that come along with that are disallowed, which says it right there, right? It can't be claimed. If the losses, so if you have more losses than gains, and I have a very quick example to show you that, if the losses are greater than your gains, then you can actually carry forward those losses indefinitely. Like there's no, like you can only carry forward the losses for 5 years. It's indefinite, right? And you can offset those losses against your ordinary income, right? So I think that's very important. The wash sale rule, very quickly. So if your sale happens here, you cannot have bought the same or a substantially similar stock 30 days before or 30 days after. So I would like to say 61 days. Just don't do it. Don't buy something similar or substantially the same. 61 days. That's the wash sale rule, in my opinion. And then here's an example. If you have investment A, you have gains, right? So you have gains, you're estimating about $7,000 of taxes. Investment B is a loss, so this is a gain. You have a $25,000 capital loss. What do? You take both, you recognize both. So you sell this for a gain, you sell this for a loss. What do? They offset each other, right? So now you actually only have, so what is negative 25,000 plus 20,000? That's negative $5,000. So you still have a $5,000 loss, right? Which is coming from this here. And so now you can actually offset it against your ordinary income. So you can offset another $3,000. So now you plus $3,000. This is to offset ordinary income. So now you still have $2,000 here remaining of losses, which you can then carry forward and offset against future gains, like capital gains, or against, again, ordinary income. That's absolutely doable. And potential tax savings here are from the gain from the stock and from your ordinary income, right? So ordinary income. So you can save about $8,000 in just taxes, which is awesome. So make sure you start building wealth now. These are some really cool strategies that I've learned. Again, I'm not an attorney. I'm not a tax advisor. I'm not an accountant, and I'm also not your investment advisor. So again, this is just for educational purposes. Make sure you hire your own professional to help you in your situation. The point is, start now. If you found this video helpful, please like and share to make sure you can help others. Subscribe to my YouTube channel, the_MMW, for really cool insights. I hope you enjoy it. Join my newsletter too for more exclusive tips. The link is in the description below. Make sure to check that out. And again, your bank accounts will thank you later. Hopefully this was helpful. Thanks again. Take care, guys.